Gold hit an all-time record of $5,600 per ounce in January 2026, then crashed, then bounced back, then crashed again, erasing every single gain of 2026 in one day, then bounced back again. Today we're breaking down gold's absolutely unhinged 2026 ride. What caused it, what it means, and whether gold is actually worth your money right now. Let's go. Let's start at the top. Gold hit an all-time high of $5,602 per ounce on January 28, 2026. For context, gold was $35 per ounce back in 1971. It crossed $1,000 for the first time in 2008, $2,000 in 2020, and now $5,600 in 2026. The thing that your grandma kept in a box under her bed is now worth more than a used car per ounce. So what drove it to $5,600? Three big things. 1. Central banks around the world went on a gold buying spree. Central banks bought a record 1,136 tons of gold in 2024 alone. China, Poland, India, all stacking gold like it's going out of style. When the world's biggest banks are buying something, the price goes up. 2. Dollar uncertainty. When people lose confidence in the US dollar, which happens when debt is high, inflation is messy, and politics are chaotic, they run to gold. Gold is the ultimate I don't trust anything else asset. 3. Everyone thought the Federal Reserve was about to cut interest rates. Lower rates mean a weaker dollar. Weaker dollar means gold goes up. So investors piled in early expecting the gains, and gold went absolutely parabolic. And then came June 5, 2026, one of the most shocking single days in gold's history. Gold fell 327% and erased every single gain of the entire year in one trading session. Not a crash, not a crisis, a jobs report. Here's the weird thing about gold that nobody explains properly. Good economic news is actually bad for gold. Why? Because when the economy is doing well, people feel safe. They don't need gold. They buy stocks instead. And the Fed doesn't need to cut rates. Higher rates mean a stronger dollar. Stronger dollar means gold goes down. The May jobs report showed 172,000 jobs added, double what Wall Street expected. That crushed hopes of a Fed rate cut, and gold paid the price immediately. Let me walk you through the full whiplash so you understand just how crazy this ride was. January 28, $5,602 all-time high, then crashes 21% to $4,400 in days, then bounces back above $5,000 in what was the strongest single-day gain in nearly 20 years. Then falls again in March, the worst monthly drop since 2013. Then June 5th wipes out the entire year in one day. Then stages its best week since January in recovery. Okay, so why does gold behave like this? Why does it go up during fear and down during good news? Let me break it down simply. Gold is essentially the world's fear gauge. It goes up when people are scared and down when people feel safe. It's not a growth investment. It's an insurance policy. The problem in 2026 was that the world swung between absolute panic and surprising optimism like 3 times in 6 months, and gold went along for every single swing. So where does gold go from here? Let's look at what the big banks are actually saying. JPMorgan, which earlier in the year had a wild $60,000 target, has now revised down to $4,500 by year-end. They still see recovery but not new record highs this year. Goldman Sachs is slightly more bullish at $4,900. They think inflation will cool by mid-2027, which would give the Fed room to cut rates, which would boost gold. Wisdom Tree's model, based on inflation forecasts and dollar strength, points to 4,563s by the second quarter of 2027, a recovery, but not a rocket ship. Okay, the big question. Should you, a young person trying to build wealth, invest in gold right now? Let's be real about this. Here's the honest truth. Gold is not a get-rich-quick investment. It never was. It's a store of value, meaning it holds its purchasing power over decades. A gold bar in 1971 bought you roughly the same stuff as a gold bar does today. That's actually impressive. But it doesn't compound. It doesn't pay you dividends. It just sits there being gold. Most financial experts say gold should make up 5 to 10% of your portfolio, not 100%, not zero. A small slice is protection. If everything else burns down, your gold holds up. That's its job. And right now specifically, with gold already down 25% from its all-time high and trading around $4,100, some analysts are calling this a buying opportunity. Others say it could fall further. Nobody knows. But historically, 10 to 20% dips in gold have been buying opportunities. It has recovered to new highs every single time over the long run. Here's the bigger picture that most videos don't talk about. The reason gold hit $5,600 in the first place is because the entire global financial system is under stress in ways we haven't seen before. The U.S. national debt just crossed $36 trillion. Central banks are buying gold instead of U.S. Treasury bonds for the first time in decades. That's a massive signal. Multiple geopolitical conflicts are running simultaneously, and countries like China, Russia, and Brazil are actively trying to reduce their dependence on the U.S. dollar in global trade. These things are structurally bullish for gold in the long run. The 2026 whiplash doesn't change that bigger story. It's just turbulence on a long flight. The plane is still heading in the same direction. All right, let's bring it home. Here's what happened with gold in 2026. Card 1 hit all-time high of $5,602. In January, Card 2 crashed 21%, then bounced, then crashed again. Card 3 erased all 2026 gains in one day. On June 5th, Card 4, good jobs report, bad day for gold. That's just how it works. Card 5 banks now target $4,500, $4,900 by year-end. Card 6. Long-term story still intact, but it's volatile AF right now. Gold is not dead. Gold is not going to $10,000 tomorrow either. It's doing exactly what gold has always done, being the world's drama queen of assets, going crazy when the world goes crazy, calming down when things stabilize, and sitting at the center of every financial anxiety conversation on Earth. Drop a comment. Are you holding gold right now? Do you think it hits $5,000 again by year end? I want to know. Like the video if this helped. Subscribe for more finance content that actually makes sense for people our age. And I'll see you in the next one. Peace.